digital technology, if you have an application programming layer, so an API, that allows you to expose the data from the back end, you actually can iterate and evolve a lot of your customer-facing applications in a really agile way while still having quite an old back end. There are a lot of banks and financial services companies that have core systems that are 30, 40 years old, but can have a fairly effective engagement with customers because they can expose that data and they build some really good applications to connect to customers.
Clearly, the investment is in the front end, and to a certain extent, you can abstract the customer-facing layer from what's happening in core systems. And whilst there needs to be a certain architecture to support the provision of services at the front layer, there's certainly a way of decoupling the back end from the front end. We've seen in Australia banks providing virtual only, setting up new entities which are entirely digital. They've managed to actually separate the front end and anything that touches the customer from core banking. So still leveraging core banking within the mothership or the home entity, but for the new entity, just concentrating on any layer that touches the customer and using digital technology in order to provide a great customer experience for those purposes.
Obviously, if you could start from scratch and have a brand new back end, then you absolutely would do that. But some of these systems investments are in the billions of dollars to make that replacement. And so, what we've found, and then these projects are very risky. So you have overruns, you have the potential to really impact the business. What we found is that if you can break the core systems down by function and replace it bit by bit while getting really quick time to value, so adding in new modules, new systems, and then building a really great customer experience, then you can maximize the value of these core systems replacement projects while then reducing the amount of legacy system that you still have in the environment, and over time replace that without doing it as a big bang.
If you look at examples in the UK, we've seen banks started up from scratch for the sort of value that you would do a basic core systems replacement in a traditional bank. So if you had your chance to start today, you would be able to set up a whole bank for the sort of value that it might be to tweak an existing core system now. So clearly, the complexity in the back end is if you don't have to deal with it, it's probably best to avoid doing that if you can manage the abstraction in terms of, from an architecture standpoint. So I think there are several techniques that people are using in order to make sure that when people fail, that they do fail fast and fail reasonably cheap. The first one is the notion of prototyping, and right now there are various techniques that can allow people to prototype an idea quickly and cheaply, test it with real users, even if it's something as simple as a paper-based prototype, and determining whether there is willingness to invest beyond that, or whether actually the idea is wrong and therefore cheaper to start again at that design phase rather than going into heavy investment. The other area that we're seeing across all of our digital engagements beyond financial services, but certainly within financial services, is the uptake of Agile as a delivery methodology. And that allows banks and allows our customers to iterate and also to change their requirements as they go through a project delivery. So typically in the past where engagements were fixed fee with a waterfall model, and we agreed the scope up front and then delivered something at the end, and any changes were managed by a pretty arduous change request process. We're certainly seeing nowadays that agile techniques in delivery allow our clients to be more responsive to changing needs and to adapt as the project evolves, and therefore ultimately give more satisfaction in the end result.
I think it's really important to be very clear on the outcomes that you're trying to achieve with the project or the technology that you're deploying. You need to understand, are we trying to increase, say, customer acquisitions by 30%? Or we're trying to get account completion rates, above 20% increase. And I think if you've got these metrics, what you can do is put something out, very quickly test and learn to see what outcomes are being achieved. If you're not achieving it, you might be able to tweak it a bit, but fundamentally after a period of time, you work out if this is going to be successful or not. And so I think having the analytics on how the product or service is actually performing and then feeding that back in relative to the KPIs that you've set is incredibly important. So I think security is actually a really important part of the customer experience. Particularly for financial services companies, nothing is more important to people than their money and their well-being. So you have to have the confidence that, if I engage with you through digital channels, that everything is going to be okay. So I think that that security question needs to be built into architecture, it needs to be built into customer experience, and then it needs to be tested thoroughly by both the organization and external parties so that there's a strong degree of confidence that things will be okay.
There's a really interesting balance there. So undoubtedly, people need to feel that whatever interaction they have with a financial institution is secure. But equally, if the security measures that are put in place fundamentally make the customer experience so jarring that it's easier to go into branch or to phone, to have a phone call, etc., it really undermines the benefit that you have by delivering a digital experience. And so, understanding what's really necessary from a security perspective and what is actually superfluous is an important balance to make.